Welcome to Class Act Lifestyle, your go-to hub for mastering the art of living well. Here, we empower you with life-changing skills, practical wisdom, and inspiring ideas to lead a fulfilling lifestyle. Discover a treasure trove of teachings from personal development to health, relationships, finance, and more. Hello. Welcome back to our exploration of the fascinating world of banking and money. In this video, we'll delve into the core logic behind the banking industry, understand the various types of banks with real-world examples, and explore the different forms of money that underpin our modern economies. So let's dive in. The banking industry operates on a fundamental logic that revolves around the allocation of financial resources, the management of risk, and the facilitation of economic activities. At its core, banks serve as intermediaries, connecting those with surplus funds to those in need. Here's an overview of the key elements that define the logic behind the banking industry. Intermediation of funds. Banks act as intermediaries between those who have surplus funds, including depositors and savers, and those who require funds, such as individuals, businesses, and governments. They accept deposits from customers and then lend or invest these funds in various ways to earn a return. Safety and security. Banks provide a safe and secure environment for people to store their money. They offer various deposit products like savings accounts and certificates of deposit, often insured by government agencies such as the FDIC in the United States, to protect depositors against the loss of their funds. Payment and transaction services. Banks offer a wide range of financial services, including payment processing, check clearing, wire transfers, and electronic funds transfers, EFT. This ensures the smooth flow of money within the economy, facilitating trade and commerce. Credit provision. One of the central functions of banks is to provide credit in the form of loans to individuals, businesses, and governments. This credit supports economic growth, investment, and consumption. Banks assess creditworthiness and allocate funds to borrowers based on risk and return considerations. Risk management. Banks play a critical role in managing and mitigating various financial risks, including credit risk, interest rate risk, liquidity risk, and operational risk. They use risk management practices and financial instruments to safeguard their own stability and the interests of their customers. Monetary policy transmission. Central banks, which are part of the banking industry, implement monetary policy to influence economic conditions, including inflation and interest rates. They adjust the money supply and interest rates to achieve economic objectives. Financial intermediation. Banks provide financial services and products that help individuals and businesses achieve their financial goals. These include savings accounts, investment services, wealth management, and retirement planning. Profit generation. Banks aim to generate profits through the interest spread, which is the difference between what they pay on deposits and what they earn on loans and fees for various services. These profits allow banks to cover their operating costs, provide returns to shareholders, and maintain financial stability. Regulation and oversight. Governments and regulatory bodies establish rules and regulations to ensure the soundness and stability of the banking industry. Oversight helps protect consumers, maintain market integrity, and prevent financial crises. The logic behind the banking industry is to create a system that efficiently allocates capital, supports economic growth, manages risk, and provides essential financial services while ensuring the security and stability of the financial system. The industry is an integral part of modern economies and plays a vital role in the functioning of financial markets. Now that we've explored the foundational logic of the banking industry, let's take a closer look at the diverse types of banks, each with its unique focus and purpose, along with real-world examples. Commercial banks. Commercial banks are the most common and versatile banks, serving individuals, businesses, and governments. They offer services like deposits, loans, payment processing, and various financial products. Example, Wells Fargo, JPMorgan Chase, HSBC. Retail banks. Retail banks cater primarily to individual consumers and small businesses, providing services such as savings accounts, personal loans, mortgages, credit cards, and basic investment products. Example, Bank of America, Citibank, and PNC. Investment banks. Investment banks focus on capital markets, offering services related to raising capital, advising on mergers and acquisitions, trading securities, and providing financial strategies to larger corporations and institutions. Example, Goldman Sachs, Morgan Stanley, and JPMorgan. Central banks. Central banks are government institutions responsible for managing a country's monetary policy, issuing and regulating currency, setting interest rates, and supervising other banks for financial stability. Example, Federal Reserve, USA, European Central Bank, ECB, and Bank of England. Cooperative banks. Cooperative banks are owned and operated by their members who are typically customers or employees of the bank. They offer various financial services, often with a community focus. Example, Nationwide Building Society and Crédit Agricole, France. Savings banks. Savings banks, also known as thrift banks, specialize in accepting and safeguarding savings deposits. They tend to provide lower-cost banking services. Example, Savings Bank of Ireland and Sparkasse, Germany. Private banks. Private banks cater to high-net-worth individuals, offering personalized wealth management services, investment advisory, estate planning, and other specialized financial services. Example, UBS, Credit Suisse, and Coutts. Online banks. Online banks primarily operate digitally without physical branches. They provide competitive interest rates on deposits and often have lower fees due to reduced overhead costs. Example, Ally Bank, Chime, and Marcus by Goldman Sachs. Islamic banks operate in compliance with Islamic principles and Sharia law, focusing on profit sharing and asset-backed financing while avoiding interest-based transactions. Example, Kuwait Finance House and Dubai Islamic Bank. Development banks, often established by governments or international organizations, fund projects and initiatives that promote economic development, such as infrastructure and social programs. Example, World Bank, Asian Development Bank, and African Development Bank. Credit unions. Credit unions are member-owned financial cooperatives offering banking services to their members. They emphasize community-based services like savings accounts, loans, and other financial products. Example, Navy Federal Credit Union and Alliant Credit Union. These various types of banks serve different needs within the financial landscape, reflecting the diverse requirements of individuals, businesses, and governments. Money, as a medium of exchange, can take various forms based on its physical characteristics and functions within an economy. Let's explore the primary types of money each with its own unique attributes and real-world examples. Let's take example of John for this. Commodity money has intrinsic value because it is made of a valuable commodity such as gold, silver, or other precious metals. For instance, John might possess gold coins, silver bars, or even goods like cattle or grains, which he could trade with others in his community as a form of money. Fiat money has no intrinsic value and is not backed by a physical commodity. Its value is determined by government decree and the trust of the people who use it. John, like most individuals, uses fiat money daily for transactions. This includes using the US dollar or another government-issued currency to buy goods and services. Cryptocurrencies like Bitcoin, Ethereum, and Ripple are digital or virtual currencies. John might have a digital wallet containing cryptocurrencies, which he can use to make secure, decentralized transactions without the need for intermediaries like banks. Bank money or demand deposits refers to funds held in John's bank account. He can easily access this money for everyday transactions by writing checks, using a debit card, or making electronic transfers. Legal tender is money recognized by a government as an acceptable form of payment for debts and transactions. For instance, when John receives a paycheck or goes shopping, he uses coins and banknotes issued by the government as legal tender. Electronic money like prepaid cards, mobile wallets such as Apple Pay or PayPal, and digital payment systems like Venmo offers John convenient and secure options for online transactions, purchases, and payments without needing physical currency. John might come across local currencies in his community such as the Bristol Pound in the United Kingdom or the Berkshires in Massachusetts, USA. These are issued to encourage spending within specific areas and support local businesses. In some situations, John may engage in barter, directly exchanging goods and services with others without using traditional forms of money. For example, he might trade his bicycle for a lawnmower with a neighbor, effectively participating in a barter system. These different types of money serve as a means of facilitating trade and economic transactions within a society. The form of money used can vary depending on factors like technological advancements, economic policies, and cultural norms. Thank you for tuning in. Hope you have enjoyed the video. Don't forget to share it with your friends and family. I'll catch you in the next one. Please like and subscribe.